Alright, without further ado, let's get this show on the road. This is Sri of Phillip Futures. We're going to be having a webinar on your guide to stock index futures. With us today is Nicolas Suiffet of Trading Central, and he's going to be covering walking you through the Asian market research technical analysis consisting of SiMSCI, the KLCI, the Nikkei, the Hang Seng, the A50, the Nifty, as well as covering doing some cross-asset research as well. He'll be covering the Treasury Bonds, gold, and crude oil prices. So this will be a very good opportunity to have your queries addressed, and also a good chance to speak with a technical analysis specialist who will be able to walk you through on the opportunities in the near term and the long term as well. All right, Nicholas, if you're available, we're good to have you on right now.
Okay, thank you.
Yeah. Sorry, Nicholas. Before I hand the reins over to Nicholas, can I just do a sound check? If you can hear us clearly, please type yes in the question box, and if at any point in time, if you have any questions at all, please type them in the question box as well. Thank you so much, Wei Sing, Adrian, Huang Yang. All right, thank you so much for letting us know they can hear us clearly. If you have any questions at any point in time, please do type them in the question box. And now, without further ado, over to you, Nicholas.
Okay, thank you, Sridaran, and welcome everyone to this webinar. So yes, first we can do a quick check sound. So if you can't me very well here, you can let me know right now. Otherwise, I will start the presentation. But I think it should be okay. So okay, thanks everyone. Okay, thank you, Louis, thank you everyone. Okay, let's start. So as explained, we will try to focus today our attention on the Asian equity indices and also on commodities and US Treasuries. So the goal of this webinar will be to give you the technical picture of on most of one of the most famous equity indices, and we do believe that the next year will be very interesting for traders because we have seen a lot of interesting signal coming from the Asian market recently in the past weeks or the past months. So the big picture, the technical picture, is pretty interesting, and next year should be very interesting for traders. So I will show you some interesting technical configuration, and I will, of course, if you have questions, you can ask me all your questions. If it's from a chartist point of view, or if you want to have a if you have a question regarding, I don't know, technical indicator, you want to learn more, you can ask me all your questions at the end of this presentation. And yeah, so let's start with the first index. Sorry. So let's start with the first index, but first I will just introduce myself. So as Sridaran told you, my name is Nicolas Suiffet. I'm in charge of the European equity strategies at Trading Central. So my goal is to provide a chartist approach and mathematical approaches from intraday trading to swing trading and even long-term investment to institutional and private banks. I graduated from a French university, which is called Paris Dauphine University, and also And also, I'm a qualified member of the Society of Technical Analysts in London. And prior joining Trading Central, I served as a market economist for a French equity broker, which is called Exane BNP Paribas. And also, I used to work in a global macro strategy department at Société Générale, which is a French bank, famous French bank. So let's start with the first index we will see today, which is the MSCI Singapore market. So you can see on this slide, you can see the technical picture of the MSCI Singapore market. This is the long-term view, as you can see here. So what we could say on this one is that, to be clear, that's not the most interesting index at the moment in Asia. As you can see, prices remain stuck within a trading range since 2010. You can see the upper end here of the trading range and the lower end of the trading range. So it's been a long time that prices remain stuck within this trading range, around 7 years. So it's a long time ago. And prices are currently approaching, as you can see here, from the upper end of this long-term trading range. So on a long-term basis, that's a sideways market. We can definitely say that prices remain stuck in a sideways market. Prices have rebounded, strongly rebounded from the lower end of the trading range at the beginning of 2016, and the direct rise towards the upper end of the trading range allow us to think that we could see some profit taking around the upper end of the trading range, so around the 386, 387 resistance threshold. So on a more long-term run, we can identify a key rising trend line, as you can see here. So this bullish trend line supports the long-term bullish trend. However, as I explained, the proximity of the key resistance threshold is a warning signal saying that maybe investors have to remain cautious, as these levels may trigger profit taking in the coming weeks and maybe in the coming months also. So the technical picture is bullish, but be careful. The proximity of this key resistance threshold, which correspond to the upper end of the medium-term trading range, is a warning signal and could and may trigger profit taking around this area. So if you are long, if you are already long on this, on the MSCI Singapore index, we would suggest to take profit around this area when prices will test the upper end of the trading range. If you are not in position within this index, we would advise you to stay away from this one for the moment and to wait for a better signal thanks to the validation or not of the sideways market, of the consolidation market. So we need to see a clear push above the upper end of the trading range before going strongly long again. And then if we can validate, if we can validate the breakout of the upper end of the trading range, we could expect further rise towards the historical high, as you can see here, and it would open the way to a huge potential upside. But it's not done yet, so be careful on a more short-term basis. Be careful with this resistance area, which could trigger profit taking. If we look at the same index on a more short-term view, so this is always the MSCI Singapore index, but this is the short-term view because I wanted to show you the daily chart and the weekly chart. So the previous one was a weekly chart, so it's a very long-term chart. This one is a daily chart, as you can see here, 1 day. So on a daily basis, what has been very interesting on this one is the validation of a V bottom pattern, as you can see here. That was the bullish event, the major bullish event, which happened at the beginning of 2016. Then we have seen the validation of this very interesting triangle pattern. So the validation and the breakout of this triangle pattern has triggered a bullish acceleration. And since then, the index remains in a bullish trend, supported by the 50-day moving average. And sometimes we have some consolidation below the 50-day moving average, but nothing, no reversal signal appear. So on a very short-term perspective, we can notice that the support base has formed at 375. This is the blue line, as you can see here. So this is the first support threshold to watch out closely. If you want to invest on a short-term basis, please keep an eye on this level. Prices need to stand above 375 to maintain the bullish bias. This is what we call in technical analysis an overlap area. An overlap. So this is a former resistance threshold which becomes a support threshold. So 375 is an interesting support threshold to watch out closely in the coming weeks. As long as prices are holding above this support, we could expect further rise. But as I explained, be careful, because on a medium-term basis, we have a resistance threshold which is very close. And furthermore, on a daily chart, we can also notice that the daily RSI has posted a bearish divergence, which is a warning signal, not yet a bearish signal, because the RSI is holding above 50%. So we have some breathlessness patterns, some breathlessness signals, some warning signal coming from the RSI on a daily basis, and we have also warning signal on a medium-term chart. So to be honest, on this index, we would be a bit cautious on a short to medium-term basis, as prices are close to the upper end of the long-term trending range. So if you are already long on this one, you can keep your position until prices break below 375. So that could be a trailing stop, that could be a short-term stop for you if you are in position. If you have a long position on this one, you can keep it as soon as prices are holding above 375, the blue line. If prices break below this support, we would advise you to close your position. So if you are not in position, we will not advise to buy now. If you are in position, we would advise to keep your position until as soon as prices are holding above 375. So that's it for the MSCI Singapore index. Let's switch to the Nikkei. The Nikkei is very interesting. On a medium-term basis, we have seen a major bullish signal in the past weeks. Let me show you this chart, which is pretty interesting. So this is a very long-term chart, as you can see. So you can see the chart from 1990, so almost 20 years ago. We can see the top, the huge top of the Nikkei, which was a long time ago, around 38,000, more than 38,000 price. So that's very long-term top. And what happened last year was pretty interesting. As you can see on this chart, prices have broken above a key declining trend line, as you can see here. So prices have broken above this resistance threshold in 2014. And after a bullish acceleration, prices have posted a pullback, have completed a pullback towards this former negative trend line. So towards this former negative trend line here. So this is a strong support threshold right now, because prices have posted a pullback, have completed a pullback towards this support threshold, this support trend line, before resuming their uptrend. And as you can see also, prices have rebounded from the rising 50 months moving averages. This is the blue line. So the blue line should be a strong support threshold in the coming months on the Nikkei. So currently around 17,781 mark. This is a strong support threshold for the coming weeks and months. So we have clearly seen a reversal uptrend signal on a long-term basis on the Nikkei. That's why we think that the Nikkei should be very exciting next year, and we would clearly advise you to buy the dip on the Nikkei in the coming days, in the coming weeks and the coming months, because prices have validated this huge bullish signal thanks to the validation, thanks to the breakout of the declining trend line. At the same time, we can notice that the monthly RSI, so you can see here that we have technical indicators, which is called the RSI 14 period with a 9 moving average. So the 9 moving average is the red line and the RSI is the blue line. And we have seen something very interesting on these technical indicators. Why? Because let me show you that. You can see at this top on prices, the RSI was overbought at the same time. So prices are making a top and the RSI is overbought within this overbought area, so above 70%. You can see later on this top on prices, so the top hit in 2015, you can see that at the same time the RSI, the monthly RSI, was also overbought. So that's why we have seen a consolidation move just after reaching this key resistance threshold, because the oscillator was clearly overbought in overbought area, meaning that prices need to take a breath before resuming its uptrend. So at this time and this time, the RSI, the monthly RSI, was overbought. But this time it's different. Why? Because as you can see here, prices are making new high above the previous top, but the RSI is clearly lower than this top, than the former top. It means that the RSI has still upward potential because it's not clearly overbought. It's just in a small overbought area, just above 70%. But as you can see here, the RSI can reach 80%, 85% very easily on the Nikkei. So on the long-term run, on a monthly chart, prices are not so much overbought. So prices are making new high and the RSI is not so much overbought. So that's a positive signal saying that we should see further rise in the coming months. Also, we can notice that Bollinger Bands are widening. As you can see here, Bollinger Bands were flat between 2015, 2016, and at the beginning of 2017. But since mid 2017, Bollinger Bands, the upper Bollinger Bands is widening. What does it mean? It means that prices have entered into a new uptrend on a monthly chart. So that's also another positive signal coming from the Nikkei. So that's why we are pretty confident in a further rise on the Nikkei in the coming months, and that could be very exciting for traders next year. On a short-term basis, to be crystal clear, it's a bit overbought. The market on the Nikkei is posting a pullback, but definitely our advice would be to buy the dip on the Nikkei and to expect a further rise. What's the target? What's the next bullish target on the Nikkei? Pretty simple. We can calculate the target by reporting the height of the previous bottom from the previous bottom at 7,000 until the trend line, the bearish trend line, from the breakout point to the breakout point at 14,800. And then we can find a bullish target, a first bullish target, which is set at 26,600. So as you can see, the bullish target is pretty far away, so there is clearly still upward potential on the Nikkei. So our advice would be to buy on dips and to see 26,600. The invalidation point, the stop loss, would be at 14,800 on a medium-term basis. Of course, on a long-term basis, of course, it's a very far away technical support threshold, but on a long-term run, that's the invalidation level. it means that if we see a pullback towards, for example, 18,700, so around the 20-week moving average, it would be a buying opportunity. So take advantage of any pullback toward this support threshold to enter a long position on the Nikkei and to expect a further rise. So for us, that's a very interesting index for next year. We will keep a close eye on this one, and we will try to buy on dips and to expect further rise towards the 26,600 resistance threshold, and in extension we can expect 29,100. So that would be our call for next year. We have interesting bullish signal coming from the breakout of this trend line, coming from Bollinger Band, which are widening, and from the monthly RSI, which is not clearly overbought. And first support threshold for support, the first support area would be around the 20 and 50 months moving averages, as you can see here. So around 18,700 and 17,700. So keep a close eye on the Nikkei for next year. Let's switch to the next one, the Seng. The Seng also is pretty interesting. Why? Because as you can see on my charts, this is also a monthly chart. As you can see here, 25 days. So this is a monthly chart on the Seng. So it's a long-term view, but we are talking about next year investment for 2018. So that's why this one is also pretty interesting on a medium to long-term run. Why? Because prices have escaped, as you can see here, from a symmetrical triangle pattern. Symmetrical triangle pattern can be continuation trend pattern or reversal trend pattern. It depends on the configuration. So be careful if you like technical analysis. When you can identify a triangle pattern, my advice would be always wait for the breakout before saying it's a bullish pattern or it's a bearish pattern. It's very difficult to anticipate the breakout on the triangle pattern, on the symmetrical triangle pattern. It can be either a bullish pattern or a bearish pattern. So yeah, keep in mind that it's better on symmetrical triangle pattern. It's better to wait for the breakout. And we have seen the breakout on this symmetrical triangle pattern. We have seen this breakout this year, at the beginning of this year. So that's a bullish event, clearly, on the Seng, and we would expect further rise as long as prices are holding above the 24,400 mark. So that's a key support threshold coming from the previous top. It's just right there. That's a long upper shadow, as you can see here, and it corresponds also to the 20 months moving average. So 24,400 is the invalidation level of the bullish trend, for the bullish trend. So as long as prices are holding above that support threshold, we will remain bullish, and we would expect a further rise towards the previous top, the historical high, it at 31,960. So this is the gray line, as you can see here, around the previous top, it in 2007. So that would be the first key resistance threshold. We can notice that the upward potential could be a bit limited on this one, on the Seng. So we are definitely bullish on this one, but be careful. That would be an interesting profit-taking area around 31,960. So our advice would be to benefit from the current technical picture, which is bullish, to enter a long position, and until prices can reach the 31,960 mark. If you look at technical indicators such as the weekly RSI just below, the monthly RSI, sorry, just below, we can also notice that the monthly RSI has broken above a declining trend line, so that's a bullish signal. And the RSI is supported by a short-term rising trend line. So that's bullish, and furthermore, the RSI is holding above its 9-period moving average, which is in red on our chart, currently around 65%, as you can see here. So the RSI is holding above this moving average, and the RSI has broken above a declining trend line and is supported by another short-term bullish trend line. So that's positive. We can also notice here, just wanted to mention this bullish technical event. This is the bullish cross between the 20 months moving average and the 50 months moving average. It's a very unusual bullish cross. So that could be a bullish signal on a long-term run. Of course, there is a lot of lag coming from this kind of bullish event, but that's a bullish event. So keep in mind that if we have some pullback, for example, prices can post a pullback towards the triangle pattern, the former trend line, just right there. It would be a buying opportunity and to see a further rise towards 31,960. So according to this technical picture, the technical picture on the Hang Seng, the view is bullish. To sum up, above 24,400, the bias remains bullish, and we expect further rise to test the former high at 31,960, and in extension, we can target a Fibonacci projection target at 36,350, which is a projection target of the previous up move. So from this bottom to this top, reported to this bottom. And we can find the 100% projection target, which is set at 36,350. Okay, so that's it for the Hang Seng market. Let's switch to the next one, which is the Nifty. The Nifty is pretty interesting also, as you can see here. Why? Because prices are validating, have escaped from a triangle pattern, have broken above this key declining trend line, as you can see here. So this is a long-term chart, always a long-term chart. You can see here a 25-day. So this is a monthly chart on the Nifty. And we expect a further rise on the Nifty market because prices have escaped from this key symmetrical triangle pattern, as you can see here, and prices remain supported by a key rising trend line. And Bollinger Bands are widening, another bullish signal. You can see here, Bollinger Bands are flat between 2014 and 2017. So it's a long-term consolidation, more than 2 years consolidation. It's a long-term consolidation. And prices have escaped from this consolidation phase. And now Bollinger Bands are widening again, meaning that we are in an uptrend and meaning that we could see further rise because the monthly RSI is not clearly overbought. As you can see here, you can see that around this previous top, around 8,780, the monthly RSI was overbought, but right now it's far below from the key resistance threshold. So there is still room for a further rise. So as long as prices are holding above 87 and 80, we will expect a further rise towards Fibonacci projection target, which are set at 10,870 and around 13,300. The Fibonacci projection target are calculated from the previous bottom hit here to this top, reported from this bottom, and we can calculate 100% projection and 1.6180% projection level, and this one is the 13,300 target. So as you can see, on a long-term run, we are definitely bullish on the Nifty, and we expect a further rise. So the advice would be buy on dips. We are in a bullish trend clearly on a long-term run. So take advantage of any consolidation to buy the Nifty to expect a further rise. So we are pretty confident that the next year will be very exciting also on the Nifty, and we would advise you to be bullish as long as prices are holding above 97 and 80. We would remain bullish, and we would expect further rise towards 10,870 and 13,300. let's switch to the next one, which is the FTSE China A50. Let me just see. Okay, so this is the chart of the FTSE China A50, as you can see here. This is a weekly chart, a 5-day chart, as you can see here. So we have historical data starting from 2015 until now. And what we can say on this index is that it's a bit tricky. It's a bit tricky from a chartist point of view, from a technical point of view. It's a bit tricky, and we could be close to a profit-taking area. Why? Because as you can see here, prices are in an uptrend. We have seen a direct rise from the breakout point of this triangle pattern. We can see here the triangle pattern and the breakout point. So keep in mind, I repeat again, but it's important to keep in mind that regarding triangle pattern, we need to wait for the breakout before saying if it's a bullish or a bearish pattern. In this case, it was a bullish pattern thanks to this breakout here. As you can see, at this point, we have seen a huge bullish signal on the FTSE China A50. Why? Because we have seen the breakout of the pattern, of the triangle pattern, and at the same time, we have seen what we call a volatility breakout on Bollinger Bands. As you can see here, Bollinger Bands were very, have narrowed a lot until this area, and suddenly the bullish acceleration triggered widening Bollinger Bands. So when prices, when Bollinger Bands are very close from each other, the upper and the lower Bollinger Bands, and suddenly we have a bullish acceleration. This is what we call a volatility breakout on Bollinger Bands, and this kind of signal is a strong bullish signal. So that's why I wanted to show you this. When you are looking at technical picture, if you like technical analysis and you are looking at charts, don't forget to have a look at Bollinger Bands, because in this kind of configuration, it's a very strong signal and it can deliver very strong signal for you as you are traders, you are trying to invest on the market. So using Bollinger Bands, you can identify volatility breakout and you can identify very interesting bullish or bearish technical configuration. So in this example, it was a strongly bullish signal at this time. And then, as you can see, we have seen a direct rise with almost no consolidation, a direct rise towards the former high hit at 19,436, so the green line. And this is the previous top hit in 2015. So that's why now we are a bit more cautious on this one, and you should be cautious according to us, because this level may trigger profit taking in the coming weeks, or maybe the coming months. So that's why we would advise you to stay away. If you are not in this index at the moment, we would advise you to stay away from this one. We would prefer the Nikkei or the Seng or the Nifty. The FTSE China A50 is a bit overbought at the moment, as you can see on the weekly RSI. So just below, you can see the weekly RSI, and you can see here that the RSI is highly overbought, around 86%. What does it mean? It means that prices need to take a breath. Prices need to consolidate from the recent gains. So the combination of this resistance threshold of the former top at 19,000, around 19,400, and the fact that the RSI is overbought allow us to think that we should see consolidation move on a short to medium term basis. So our advice would be stay away if you are not in it, and if you are in it, we would advise you to take profit around this resistance threshold 9,435. Okay, so the next one, let's switch to the next one. So the next one is the FTSE Bursa Malaysia, so the KLCI. This one is a little bit less interesting, to be honest. Let me explain why. Why? Because as you can see here, so this is a weekly chart, so 5 days chart, as you can see here. And what we can notice on this chart is that prices remain capped by a key declining trend line, and prices struck against this declining trend line in the middle of 2017, and prices have entered into a consolidation phase, as you can see here. Furthermore, prices have validated what we call a double top pattern, as you can see here. I draw the double top pattern. Maybe some of you already know this pattern, because I presume that you are familiar with technical analysis a little bit. But double top pattern are reversal trend pattern. So when you can identify such a pattern, you can close your position, or you can take advantage of the validation of this pattern to open short sell position on the market. So that's why the validation of this pattern, this reversal downtrend pattern, combined with the key declining trend line drawn from 2014, allow us to think that we could see further decline first, as you can see here, on a short to medium term basis. So that's not very interesting, I think, from a chartist point of view for 2018. It should not be a very interesting index. We would advise you to stay away from this one. We could see some choppy price action, choppy market. And clearly, we need to see a break above the 1795 mark. So we need to see a break above this resistance threshold to become more confident. We need to see a break above 1795 to become more confident on the Malaysian index. Such a break would clearly open the way to a further rise, because we would break above the key declining trend line. So that's why that would be a bullish signal, but it's not done yet. And again, the validation of the double top pattern is a warning signal on a short-term basis, and prices remain capped by this key declining trend line. So that's a mixed signal, and we would advise you to stay away unless prices can break above the resistance threshold. Only a push above 1795 would clearly be a buying signal on this one. So as long as prices are capped by this resistance threshold, stay away. It's not very interesting. If prices can break above 1795, you can buy this one, and that would be interesting. But our view for next year is a bit mixed on this index, and we would expect sideways market and nothing very interesting to do, as prices remain capped by this key declining trend line and have validated a double top pattern. Let's switch to the next one. So we are finished with the Asian indices. So let's start now with the cross-asset research. So we will speak, as Sridharan explained to you, we will speak about the US 10 years and the crude oil and the gold, and then the gold prices, because it's very interesting to have all the view in mind when you invest on the market. It's good to know, if you buy the Asian indices, it's good to know where is going the crude oil, where is going gold. If gold is clearly in an uptrend, it could be a warning signal from the equity market. So that's pretty interesting for you when you try to invest on the market, to have a big picture, to keep in mind the big picture. So you should keep in mind the technical picture of the gold, of the crude oil, and the 10 years. So let's start with the 10 years T-note. So this is a chart of a 10 years T-note. This is a weekly chart, as you can see here, 5-day chart. So this is a weekly chart. So one bar represents 1 week of trading. You can also find 2 technical indicators. So you can find the RSI, as in the previous chart. RSI 14 with a 9 period moving average, and you can also find the MACD, the MACD index with the configuration 12, 26, and 9. This is another very interesting technical indicators which allow us to identify the bullish and the bearish trend and the reversal signal, reversal trend signal. So on the 10-year T-note, when we can notice, which is very interesting to notice, is the breakout of a key declining trend line. As you can see here, prices were capped by this key declining trend line. This is a long-term one. As you can see, the chart started in 2012, and even if on a long-term run, even if 2008, you can draw this trend line. So this is a long-term trend line, and prices have broken above just here this key declining trend line. So that was an interesting bullish signal coming from the 10-year T-note with such a breakout. And we can also notice that prices have landed just here on a key support threshold around 1.38. So this is the blue line. So that will be the invalidation level for the bullish trend, because that was a key previous bottom hit in 2012, and prices have rebounded again from this key support threshold around 1.38%. So that will be a massive support threshold to keep in mind in the coming months in 2008. So keep in mind that 1.38 is a massive support threshold. Another intermediary support threshold is set at 2%. This is the dotted line, as you can see here. So this is a short-term support threshold, and we would advise to be bullish on the US 10-year T-note as long as prices are holding above the 2% support threshold and even the 1.38% support threshold. Why? Because we have seen the bullish signal coming from the breakout of this key declining trend line, and we have also seen the breakout of the trend line on the weekly RSI, as you can see here. So now prices are consolidating within what we call a broadening formation, and that's a short-term consolidation, short to medium-term consolidation, but the trend remains bullish thanks to the breakout of this pattern, so of this trend line. So the trend has reversed up thanks to the breakout of the trend line. So prices are consolidating within this pattern, and a break above the former top just here around 2%, 2.40%, that would be a massive bullish signal from the US 10 years, and we would advise to be long, strongly long on the US 10 years if prices can manage to push above this resistance threshold at 2.40%. What's the bullish target? The bullish target, always the green line. The bullish target, the first one, is set at 3% because it corresponds to the former top here, hit in 2014, so 3 years ago. So that's a massive resistance threshold, and that's a psychology resistance threshold, the 3% also. So investor may keep in mind that it's an important resistance threshold, 3%. So we expect at least a bullish acceleration towards the 3% area. And in extension, we can see the 3.35% resistance threshold. Why this one? Because it's a Fibonacci projection level calculated from the bottom, it's in 2016 here at 1.38%. From this bottom to the previous top, it here reported from the bottom, it here at 2%. And we can calculate the 100% Fibonacci projection target, which is set at 3.35%. So that's the maximum objective, the maximum target for next year on the US 10 years, 3.35%, with the first resistance threshold at 3%. So to sum up, we are bullish on the US 10 years as long as prices are holding above the 2%, 1.38%. We expect a new up leg toward 3 and 3.35% in extension. let's switch to the commodities now, and let's talk about the gold. So the gold is not very interesting. To be crystal clear, I will be short on this one. Why? Because it's not very interesting. As you can see here, prices remain stuck within a triangle pattern, a symmetrical triangle pattern. You can see the top and the bottom. And as I said to you, regarding symmetrical triangle pattern, we don't want to anticipate the breakout of the pattern. So what we can see right now is that prices are consolidating within this symmetrical triangle pattern, and we don't expect so much on the gold price. If you look at on a more long-term run, we can see that prices remain stuck in a trending range. This is the dotted line. So between 14.33 and 10.40, so the dotted line, that's a long-term trending range. And prices remain stuck within this trading range and remain stuck within the symmetrical triangle pattern. So clearly there is no momentum on the gold prices right now, and we would advise you to stay away from the gold prices. From a chartist point of view, this is not interesting. Unless prices can break above the upper end of the symmetrical triangle pattern. That would be a bullish signal, but it's not done yet. So it could take time before prices can break above the symmetrical triangle pattern. So if prices break the lower end of the pattern, of the symmetrical triangle pattern, it would be a bearish signal, and it would call for a retest of the 1040 support threshold, so the dotted line. In case of the upward breakout of the upper end of the symmetrical triangle pattern, it would be a bullish signal, but it's not done yet. And as I explained, we never anticipate the breakout of symmetrical triangle pattern. It's very dangerous because it can be either bullish pattern or bearish pattern. So all what we can say right now on the gold prices is that it's neutral. We are neutral on the gold prices because gold prices remain stuck within the symmetrical triangle pattern. If you look at the weekly RSI, the RSI is around its neutrality area, the 50% neutrality area. So it means that it's neither bullish nor bearish. And we can also see that moving averages, the 50-week moving average is flat, meaning that there is clearly a lack of momentum on the gold prices. So as long as prices remain within the symmetrical triangle pattern, stay away from the gold prices. It's not interesting according to us, and you should invest your money in a better product. And maybe the gold, the crude oil is a better product, and we think so. Crude oil is a better product. When you look at this chart, it's clearly interesting. Why? Because we have seen a lot of bullish signal coming from the crude oil prices. First, prices have validated what we call an inverted head and shoulders pattern, as you can see here. That's a reversal uptrend pattern. If you are familiar with technical analysis, with technical patterns, with a chartist pattern, you can you must know this pattern, this very famous pattern, which is called the inverted head and shoulders pattern. This is a reversal uptrend signal. So this pattern has been validated last year, just here, but prices failed to accelerate. And first, prices have posted a pullback, a consolidation move towards the right shoulder of the pattern, around 39. But prices didn't break below the key support threshold, so the pattern remains valid. And the reversal signal, the uptrend signal, remains valid. And then, in the last couple of weeks, prices have accelerated up thanks to the breakout of this key short-term declining trend line. That was a massive bullish signal coming from the crude oil prices. Why? Because, as you can see here, Bollinger Bands, so the red lines, are widening. So as I explained earlier, when Bollinger Bands are widening, it means that prices are in a trend, in a current trend. So the current trend on crude oil is clearly bullish. Also, we can notice that on the RSI, prices, the weekly RSI has broken above a key declining trend line, just here, and is not overbought. As you can see, the weekly RSI is around 68%. So it's below 70%. It's not overbought, meaning that we should see further rise on crude oil prices. And that could be a very interesting investment for you for next year. We are quite confident that prices will post a further rise towards the key resistance threshold at 77, which is the green line on these charts. We can also notice on the MACD, the weekly MACD, that the MACD is above its signal line. So the blue line is above the red lines and is positive. So the weekly MACD is positive and above its signal line. That's a bullish signal. And the weekly RSI has broken above its declining trend line and is not overbought. So that's bullish signal coming from the crude oil. And we are quite confident that prices will post a further rise in next year. So it could take time, but to be honest, we could see a very quick rise if prices manage to push above the 62.60 resistance threshold, so the dotted line in green, as you can see here, which correspond to the former top hit in 2015. A break above this resistance threshold would trigger a bullish acceleration, on another bullish acceleration towards the Fibonacci, towards the measure up move target of the pattern at 77. Because 77 corresponds to the measure up move target of the inverted head and shoulders pattern. And in extension, you can target 85 resistance threshold. So the view on crude oil prices is bullish as long as prices are holding above 39. So the blue line here, as long as prices are holding above 39, we expect a further rise towards 62.60, 77, and in extension 85. Only a push above 39 would invalidate the bullish sentiment, the bullish view on crude oil prices. So that would be also a very interesting product for you to invest money for next year in 2018. We should see a huge volatility on crude oil prices. Okay, so just a word on the platform, how to find Trading Central. So you can use your login to have access to our research. And you can find some reports like this one, for example. This is a report on the MSCI Singapore index. So this is intraday charts. This webinar was, the goal of this webinar was to give you the big picture for 2008. So it's a long-term view. But if you are looking for more short-term technical level, you can have a look at the technical research at Trading Central, and you can find intraday technical level on indices every day on daily basis. We provide you support and resistance threshold on the most famous Asian indices. So you can find it on the website thanks to your login. You can find report in English, and you can find also report in Chinese if you prefer. And finally, you can also have access to some videos to see what's the technical level of the day, what are the technical level to watch out closely on an intraday basis. So this webinar was a medium-term to long-term view. So I gave you some long-term technical levels, but you can find short-term technical levels, short-term support, intraday levels in the research platform. So you have just to fill in the report, and you will receive the newsletter, the daily technical levels in English or in Chinese you will receive it. So that that will be interesting for you. And of course, if you have questions, you can come back to Sridaran or to Trading Central. Okay, so that's the end of this presentation. Thanks, everyone. I will try now to answer to your question. So let me have a look at this. So regarding the where to find the technical charts in Trading Central, you have to go back to the platform. So I cannot show you this, but you can go back to Sridaran, and it will explain how to find the short-term and the medium-term view at Trading Central. So this webinar has been recorded, so you will have access to it, and you can see, you can check what's the big picture, what's the technical levels on most of the most famous Asian indices, and also you can ask your question to Trading Central, and we can explain how does it work, how we choose our technical indicators. Okay, thanks, Johannes, for your participation. Yeah, I have added some technical indicators because it's interesting to keep in mind that Bollinger Bands are quite very interesting technical indicators, such as also moving average or the oscillators such as the RSI or the MACD. So why I have added all these technical indicators? Because when you have a look at the charts, you have to look different technical indicators. You have to check moving averages, you have to check oscillators to see if the market is overbought. You have to check moving average to be to not be too much contrarian on the market, and you have also to check Bollinger Bands to fine-tune timing and to identify bullish or bearish event. So that's why I have added some a lot of technical indicators. So regarding the Seng, as I explained, we are bullish on this one. I can go back to the presentation of the Seng. It was this one. So the Seng is bullish, as I said, and we expect further rise as long as prices are holding above the 24,400 mark. We expect a further rise towards 31,960 mark, and in extension 36,350 mark. Be careful, because the 31,960 mark could be a profit-taking level on a medium-term basis. So the technical view is bullish. We expect a test of the former high hit in 2008 at 31,960 mark. And this will be an interesting profit-taking level. So that's bullish, because we have also seen a bullish cross between the 20 months and the 50 months moving average. And the monthly RSI is bullish and not so much overbought. So that's it for this presentation. Okay, so thank you everyone for your participation to this webinar. I hope it was interesting for you. I hope you will see it clearer for next year and where to invest next year. It's clearly interesting. Or maybe a last question regarding the Malaysian index. So let me go back to the Malaysian index. That's a bit tricky because, as I said, the trend is neither bullish or bearish. It's more a sideways market because prices struck against this key declining trend line and have validated a double bottom pattern. So we have bearish signal coming from the trend line and bearish signal coming from the double top pattern. On the contrary, prices are still holding above the previous bottom at 16.17. And the moving average, the 50-week moving average, is still ascending. So that's why the technical picture is a bit tricky. So for me, it's neither bullish nor bearish, and we would advise to stay away from this one. If you really want to invest, we would advise you to wait for a pullback towards the former declining trend line, this one, and it could be maybe a buying opportunity to play a technical rebound. But for the moment, we would advise you to stay away because prices have escaped from this double top pattern, which is a reversal downtrend signal. And if you want to be more confident, we need to see a break above 17.95 to become more confident for a further rise. Okay, so thanks everyone. So that's it for today, and I hope to speak you soon for another webinar. So thanks everyone, and see you soon. Bye bye.
All right, thank you so much, Nicholas. Thank you so much to the wonderful audience who have joined us today. We will be sending you a follow-up email tomorrow, so you should have access to the video, and you should be able to revise the concepts that Nicholas has shared with us, especially if you are monitoring the indices. Sorry, if you're monitoring the indices or the various commodities products that he mentioned, you should do a revision through the link in our email, which we will send you tomorrow. If you have any further questions, we'll list down the contact details of the specialists that we have, and you should be able to have your questions addressed. So do look out for our email. Keep those questions coming, and let's keep the discussion alive. Thank you so much for joining us tonight, and have a great evening ahead.